Now, one of the things you can get from our website, it's a free download. Our website is 4teamresources.com. One of the things you can get from that is a capital growth calculator. And in this example right here, what we have is a capital growth calculator showing exactly what we were talking about, a credit union that would shrink itself down. So we have a $300 and some million credit union with $25 million in capital. And you look down here and we have a capital to assets ratio of 6 point something percent. Not a lot of capital, not where you'd want to start in a recession like the pandemic recession of 2020. So they grew a couple of years and that capital to assets ratio even shrunk some more. They had very little financial ROA, that's that line up there, the ROA of 0.2% and 0.1%, and they had asset growth of 10% and 7%. So assets grew faster than capital grew. And you can see how their capital to asset ratio down here got smaller and smaller. Well, they got down to panic stage, let's say, at 5.9 something percent. So what did they do? They shrunk their credit union. Year 3 over there, they shrunk their credit union by 5% and had a little bit of profit. And what happens to the capital to assets ratio when you do that? You can bring it back up again. Now that isn't a solution you're going to use without great thought and without great need, but it is out there as a solution. And just remember, the reason we have this capital, the reason we build capital is for bad times. So we need to use it to let it go ahead and absorb the losses during these bad times. We'd like to start with a lot, but if we don't have a lot and it gets too narrow, we can always shrink our credit union. Not an easy choice, but an important choice if we want to survive over the long term.